So we are doing inventory valuation. Okay. Which international accounting standard tells you that you should value your inventory?
Prudence.
You should value your inventory. This international accounting standard is prudence.
No, the what is it?
Okay. So you have your international accounting standard 2, which is for valuation of inventory. Okay. This international accounting standard 2 tells you that you should value your inventory. You should value your inventory at cost or NRV. NRV is what? It is the net realizable value. So they say that you should value your inventory at cost or NRV, whichever is lower. Okay? When you are calculating the cost of your inventory, you will add the carriage inward to it. So whenever you are calculating the cost of inventory, if there is any carriage inward, you are going to add to it to get the correct cost. And when you are finding out the NRV is also called what? Net realizable value, or it is the market value, or it is the selling price that you get for your inventory when you sell it in the market. So when you are calculating your NRV, you should subtract from it your estimated selling expenses. What would you should subtract from it? Your estimated selling expense. And then you will compare your cost and your net realizable value. Whichever is lower, you will value your inventory at that price. Okay. Why do you value your inventory at lower of cost or net realizable value?
To not overestimate the profit.
So this is as per the concept of prudence, that you value your inventory at lower of cost or net realizable value, so that you do not overstate your profits. And
assets also.
Your current assets are shown at
more realistic value.
Your current assets are shown at a more realistic value. So because of the concept of prudence, you value your inventory at the lower price. Now we have a sum over here, which is a past paper question, and you have 3 types of chairs. Okay, you have armchair, dining chair, folding chair. Now they are asking you state the basis on which you should value your inventory on the last date.
First in, first out.
No. On the last date, you should value your inventory at?
Cost.
Huh?
Cost or NRV, whichever is lower.
Yes. So you should value your inventory at cost or NRV, whichever is lower. Okay. So state the basis on which Khalil should value his inventory. He should value his inventory at what?
Cost or NRV, whichever is lower.
Lower of cost or net realizable value. Are you with me?
Yeah.
Go to the next one. Now you have to value Khalim's inventory. How will you value? Tell me.
You will take the chair type first, then you will multiply it by the unit, by the cost or selling price, whichever is lower.
Okay.
Then you will do that for all of them, and then you will add it.
So I have the chair type. Now I have to decide the valuation. So for armchair, I will value at.
55.
For dining chair, I will value at.
25.
Huh?
No, 25.
For folding chair, I will value at
15.
15. So the valuation will come up to how much? Can you multiply and give me the answer?
Yeah. First one is 825.
Hmm.
And second one is 720.
Hmm.
Third one is 900. So the total will be 2445.
2445.
45.
So this is your inventory valuation and you will get sums which are like this. If they want to complicate the sums, they will either give you carriage inwards and selling expenses. So you have to determine your correct valuation of inventory. Okay?
Yeah.
Now you go over here. Come on, tell me. You have to show the value of Shilpa Gandhi's inventory on the 31st of January to 2010. So you have two units type. You have type A and type B. Are you with me?
Yeah.
Okay, fine. But they have also given you some additional information. Your
Yeah.
carriage
Carriage and
inward is $1 on type
4
A.
units.
So the
Yeah.
cost per unit of type A will become how much?
23.
Because carriage inward is added and selling
Yeah.
expenses is subtracted. This
Yeah.
is not included in the above figure. And they have also told you that 40 units of type B were found to be damaged and they had to be destroyed. So your type B inventory will be how much?
We will do 520 minus 40.
So it will
So
become how much?
480.
How much?
480. 480.
480. So your type B inventory will be 480. Are you with me?
Yeah.
Now you have to do the valuation. Type A how much?
360 into 23.
First give me the amount. 23 or 24?
23.
23. And for type B how much?
480 into 12.
14 or 12?
12. 12.
12. Then you will multiply and you will get the inventory valuation. How much is the amount? It is
First
360 into
one
23, which is making it 8280,
8280.
and 480 into 12, that
5760.
5760. So your
Yeah.
inventory valuation will become how much?
1440.
Okay. The next question is, name the accounting principle you have applied when you were valuing Shilpa Gandhi's inventory.
Prudence.
Prudence. Okay. Now go to the next one. A.H. Sung has a business buying and selling parts of machines. And they have given you the information about part Q. On April 1, you had 200 units in stock, which was valued at 3.20.
Hmm.
In the month of April, you have purchased these units, and on 30th April, you have this much units in stock. Net realizable value is 3. Can you give me the value of stock on 1st April?
So 200 into 3.20.
So 200 into 3.20.
640.
How much?
640.
Okay. Can you give me the total cost of purchases for April?
Total cost of purchases. Yeah, okay.
You'll just multiply it. You'll get cost of purchases.
So it's 320, 450, and 300. So the total will
320,
be
450 and 300. So what is your total
1070.
cost of purchase?
1070.
Now your closing inventory. 300 units. Now these 300 units has to be valued at cost or NRV, whichever is lower.
Yeah.
Okay. And we follow the method of FIFO. FIFO tells you the stock that was there first in, was first out, is sold out first. The method of FIFO tells you that the stock you purchase first is sold out first. So your closing inventory will be out of the most recent purchases.
Yeah.
So how many units of closing inventory you have?
300.
300. So it will be
So
out of your most recent purchases. So the last purchase is 100,
yeah, so 100.
then 150, and this would be at
You
50.
take 50 out of that.
Okay. Now the cost. It is 3, and it is 3.20. Are you with me?
Yeah.
NRV. What is the net realizable value?
One sec.
3,
So first one is 300.
3, and 3. Now you will value at what price? Cost or NRV, whichever is
Lower.
lower. So this will be at 3, this will be at 3, and this will be at 3. So
Yeah.
basically you're going to value your inventory of 300 units at the price of 3,
Yeah.
which is 900.
Yeah.
You can do this part, or you can also see over here. The lowest cost is 3. NRV is 3, so you can compare. 3 is here, 3 is here, this is 3.20, so you have to value at 3.
Yeah.
So you can do that also. Can you tell me the number of units that is sold in April? How do you calculate the number of
Six,
units sold?
600 now because you'll do
It will be opening
closing cost
inventory plus
plus purchases
purchases
minus
minus
closing.
closing. What was the opening number of units that you had?
Opening was 200 units.
200 units. How many units did you purchase? 1, 2, 3, 350. What is the closing units that you have?
300.
So what is the number of units that you have sold? You have sold 250 units.
Yeah.
Find the cost of goods sold. They want the cost of goods sold. Okay, so you have sold 250 units.
Yeah.
The first you will sell out of your opening inventory. That is 200 units you will sell, right?
Yeah.
And the cost of those 200 units is what? 3.20.
320. Yeah. 3.20.
So this would be into 3.20. And then you will sell 50 units out of 5th April. So the 50 units cost is also 3.20. So what is the cost of the goods sold? It is 250 units into 3.20. So cost of goods sold is 800. Yes,
Yeah.
let's do the next one. You say, I will write.
Okay. So the value of inventory
Read the
at
question
first,
here.
okay, at 1st October, MoMA had 200 units of inventory, which had cost $2.80 per unit. In the month of October, her purchases were October 5th,
Okay,
100
fine.
units. Yeah, that thing. Then calculate the following, show your workings. The value of inventory at 1st October, so you do 200 into 2.80. It is 560.
How much?
560.
Okay. Total cost of purchases.
Total cost of purchases will be 100 into 3.20,
Hmm. Just a minute.
which is
Yeah.
then 130 into 3.1,
Hmm.
which is 403. Then
What is 100 into
120,
3.20?
320,
130 into 3.1.
403,
Sorry.
403,
Yeah. And 120 into 2.9.
348. So total is 1071,
10.
71,
I didn't hear you. 10.
71,
7 what?
1071, 71, 1071.
Okay, fine. Now you have to calculate the value of the inventory on 31st of October. On the last day, you had 250 units of stock and the
Yeah.
NRV was 33, was $3. So the closing
Hmm.
inventory will be out of, the closing
The
inventory will be out of,
the last date you'll take now.
so will be out of the most recent purchase.
10 purchases, yeah.
Okay, fine. So your most recent purchase is here.
So you'll do 120 into 2.90.
Okay.
Then you'll do
So
kitna hai?
250 minus
250.
120. So how many
Yeah.
units you have now?
250 minus 120, you have 130.
130.
So
And the
you'll take
130 units,
130
it can be
multiplied
valued
by
at
3.
cost or NRV, whichever is lower.
So we valued at 3 because it's lower.
Yeah. So,
So the first one is 348
yeah.
and the second one is 130 into 3, which is
How
390.
much is the second one?
390.
Can you be little audible?
390. You'll do 130 into 3, which is 390.
So what is the value of your closing inventory?
738.
738. Okay. You treat your closing inventory as your income. What do you treat your closing inventory as?
Income.
Okay. So if you treat your closing inventory as income, tell me if your closing inventory is overstated. So what will happen to your profits?
Profit will also be overstated.
Your profits will be overstated, and what your current assets?
Overstated.
Your current assets will also be overstated. And how about your next year's profit?
Um,
This is your
that will be
current year's profit. How about
will
your
be
next year's
understated.
profit?
Understated.
Why next year's profit will be understated?
Because your opening stock will be more, na, for the next
Opening
year.
stock will be more. So if closing stock is treated as income, opening stock is
And
treated
stock
as,
is treated as expense.
it is treated as expenses. Okay. Tell me what happens if your closing inventory is understated.
Your profit will be understated.
Your profits will be understated, current assets will be,
Understated, and next year profit will be overstated.
next year profits will be overstated. Okay.
Hmm.
So closing inventory has everything related to the current year and next year.
Hmm.
Okay. Now let's talk about opening inventory.
Hmm.
If your current year opening inventory is overstated,
Then your profits will be understated.
then your
Current
current year
assets,
profits will be understated.
yeah, and current assets will be understated, and
Why?
next
Current
year
assets has
profit.
no effect, right?
How?
Because in the current assets, you will have what?
Last year's, yeah.
In the current assets, you will have closing inventory. Opening inventory does not
Is
come
not
in
there.
the current assets, right?
Yeah, yeah, it doesn't.
So if your opening inventory is overstated, your current
Hmm.
year's profit is understated.
Understated.
Okay, because opening inventory we treat as expense.
Hmm.
So current year profit is understated. Next
Hmm.
year profits,
Will be overstated.
my next year profit has only relation with what?
Oh, closing stock,
Closing
so no
inventory.
effect. So no effect.
Okay, and last year's profit,
Last year's profit will
because
also have
last
no
year
effect.
it was closing inventory, na?
Yeah. Oh, last year's profit will be overstated then.
Because last year it was closing inventory, so last year's profit is overstated.
Overstated, yeah.
What happens if your opening inventory is understated?
Your opening inventory is understated, your profit will be overstated.
Your profit will be overstated. Current assets
No effect.
and last year profits
Understated.
understated. So there is a direct relationship between closing inventory and profits.
Yeah.
If your closing inventory is overstated, your profits of the current year, your profits of the current year is overstated, and last year, no, next year is understated.
Hmm.
So there is a direct relationship between closing inventory and profits.
Yeah.
But there is an opposite relationship between opening inventory and profits. If opening inventory is overstated, your profits will be understated. Okay? There is a
Yeah.
direct relationship between closing inventory, your profits, and your current assets. Are you with me?
Yeah.
Yeah. So can we repeat, if closing inventory is overstated, my
Your
profit for the current
profit
year
of the
will be
current year will be
overstated.
overstated.
My current assets will also be
Also be
overstated.
overstated.
And my next year's profit will be understated.
Understated.
If opening inventory is overstated, my profits of the current year will be
Understated.
understated. The current assets will have no effect.
No effect.
Next year profit will have no effect.
No effect. But previous
But
year's profit will
last year's
be
profit will be overstated.
overstated.
Opposite of this. Can we refresh and write it again together?
Yeah.
Okay,
Yeah.
fine. So you have closing inventory. If your closing inventory is overstated, your profits of the current year will be, are you there?
Yeah, will be overstated.
Your profits of the current year will be overstated. Your current assets of the current year will be overstated.
Yeah.
Okay. And your next year's profit will be,
Your next year's profit will be understated.
Your next year profits will be understated, and last year will be no effect.
Yeah.
Okay?
Yeah, miss.
Are you with me?
Yeah.
If your closing inventory is understated,
Hmm.
then profits of the
The
current
profit
year,
will be understated
your
and
current assets of the current year,
will be understated.
and your next year profits
Um, will be overstated.
will be overstated, and last year no effect.
No, sir.
Okay. Opening inventory shares opposite relationship. If opening inventory is overstated, then profits of the current year
Profit will be understated.
then your profits of the current year will be understated. Your current assets,
No, sir.
no effect. Profits of the next year
No, sir.
and last year,
Overstated.
overstated. If opening inventory is understated, then
Profit will be overstated. Current
profits
assets
of
will
the
have no
current year
effect.
will be overstated.
Overstated.
Current
And current
assets,
assets, no effect.
next year
Next year,
profit
no effect. And last year profit will be understated.
because opposite relation.
Yeah.
Okay. Done with
Yeah.
this. Now let's do this sum.
Hmm.
We done with this sum, right? Shilpa Gandhi.
Yeah.
We are done with the relationship between the closing and opening inventory with the
Hmm.
profits. So basically, we are done with inventory value.